Hello, my name is Cameron Williams and my group members are Anthony Cartajar and Jeffrey Deng. Today, we will be analysing the Australian dollar and the US dollar market pair and its expected short-term outlook. Firstly, a quick overview of the foreign exchange market will help us display which areas affect the future position of a currency pair. The foreign exchange market is a highly competitive market comprising a vast network of different locations linked together by telecommunications. It allows for currencies to be traded by parties 24/7. The three markets inside the foreign exchange market are London, New York, and Tokyo, with a fourth smaller market in Sydney. In the competitive foreign exchange market, the foreign exchange values of currencies are determined by the supply of and demand for particular currencies. It is only from 1973 that the world major currencies were floated, and from December 1983 that the Australian dollar was floated. There are a number of explanations of the determinants of the foreign exchange value of a currency, including relative inflation rates, relative growth rates, and relative interest rates. Along with these factors, other factors which also affect the exchange rate are commodity prices, exchange rate expectations, and official intervention. We will be specifically discussing these today in relation to the Australian dollar US dollar currency pair. According to STO, the Australian dollar US dollar currency pair is the fourth most traded currency pair in the world and is the most traded currency pair in Australia. As the market is 24/7, the Australian dollar US dollar exchange rate is changing as I speak. Currently, the Australian dollar is buying 78 US cents according to the Reserve Bank Australia. This means that for every one Australian dollar you trade, you get 78 cents of a US dollar. Adversely, the US dollar Australian dollar exchange rate, buying Australian dollars with US dollars, is approximately $1.29. Displayed here is the Australian dollar US dollar currency chart sourced from xe.com, which shows the last 1 year of the Australian dollar US dollar exchange rate. This chart displays that Australian dollar buying US dollar. Key features of this chart include a low of 73.484 cents on the 9th of May 2017 and a high at 81.14 cents on the 27th of January 2018. As of April the 13th, the current price is 77.6489 cents. So, moving on to interest rates. As you can see, the current Australian interest rate is at 1.5%, according to the Reserve Bank of Australia, while the United States interest rate is 0.25% higher at 1.75%, according to the US Federal Reserve. Australia's interest rate is predicted to increase by 0.25% to 1.75% in the next 3 to 6 months. In comparison, the United States interest rate is predicted to jump by 0.5% to 2.25%. The main factors that affect interest rates are inflationary expectations and central bank actions. Inflationary expectations is the demand of loanable funds that increases demand for funds to maintain parties' pre-inflation investment plan, while supplies of loanable funds will demand a high rate of interest to maintain the rest after inflation rate of return. Central bank actions is when central banks intervene in the money market to influence the money supply by buying and selling government securities. The increase or decrease in the money supply, respectively, will result in a change in the equilibrium interest rate. Higher interest rates in America will encourage capital inflow and discourage capital outflow. Overseas investors will take advantage of the higher returns and Americans investing a greater proportion of funds in the domestic financial markets. This will create a higher demand for the US dollar, causing the interest rate to increase, as seen in the graph. Thus, the US dollar will appreciate against the Australian dollar. Now, onto interest rates. Here we can see that the Australian inflation rate is at 1.9% and the United States inflation rate is at 2.4%, according to Focus Economics. Australia's inflation rate is predicted to increase by 0.3% in the next 3 to 6 months from 1.9% to 2.2%. The United States inflation rate is also predicted to increase, but only by 0.1% to increase to 2.5%. There are two main factors that affect the inflation rates, and they are the demand pull inflation and the cost push inflation. As shown in the graph, a demand pull inflation occurs when the price level increases along with the demand of real GDP. The cost push inflation occurs when the price level increases but the supply of real GDP decreases. This can be caused by multiple things such as raising wages, pork prices, raw material prices, higher taxes, profit push inflation, and also declining productivity. As the United States has high inflation rates, there will be a decrease in demand for exports as American prices become less competitive on world markets. There will therefore be less demand for the US dollar and the demand curve will shift to the left. An increase in demand for imports as overseas goods become relatively cheaper to the American domestic market. There will therefore be increased supply of the US dollar and the supply curve will shift to the right. Thus, the US dollar will depreciate against the Australian dollar. As shown in the graphs, you can see that the Australian growth rate is 0.4, while the American growth rate is much higher at 2.9. The main factors that affect a country's economic growth rate is broken down into 5 categories. Human resource. This depends on the country and how well skilled, trained, and educated the people are. The more skilled or higher educated, the higher output would also be of high quality. Natural resource. This depends on how resourceful a country is, such as Saudi Arabia and its oil. Capital foundation. This involves land, building, power, transportation, and medium of communication. This increases the availability of capital per worker, which increases capital labour ratio. Technological development. Technology involves application of scientific methods and production techniques, so this development helps in increasing productivity with a limited amount of resources. Social and political factors. Social factors involving customs, traditions, values, and belief which contribute to the growth of an economy to a considerable extent. Since America has a greater economic growth, income and aggregate demand will be growing at a faster rate. To pay for increases in imports, there will be an increase in the supply of the US dollar in the foreign exchange market. If the higher growth involves investment projects financed through offshore borrowing by American companies, the increase in the capital inflow means an offsetting increase in the demand for the US dollar. The supply effect is to reduce the price of the US dollar, while the demand effect is to increase the price of the US dollar. The net effect will depend on the strength of each of these separate factors and the slope or elasticity of the demand and supply curves. It cannot be easily determined in advance. Australia's exports mainly consist of commodities such as minerals, fuels, and goods and services. We can see in the graph below that the price of commodities and the Australian dollar US dollar exchange rate are strongly correlated. If the commodity prices increase, exports become more expensive because of an increase in commodity prices. Importers cannot turn to other suppliers because commodity prices are a worldwide phenomenon. They will continue importing commodities from Australia, and the total value of Australian exports and hence demand for Australian dollar will all increase. An increase in the commodity prices will increase the value of Australian exports, resulting in an appreciation of the Australian dollar due to the higher demand for the Australian dollar. Displayed here are some graphs which outline why we made the predictions we will make. The graph in the top right corner displays the US interest rate increasing over the next 6 to 9 months. The following graph displays the Australian interest rate predictions staying constant over that same period. Following that are predictions of the US and Australian inflation rates for the next year, showing the US inflation rate expecting to increase faster than the Australian inflation rate. Following this is the past 12 months of data of growth rate for the Australian and US GDP. The final graph is a prediction of the Australian dollar US dollar exchange rate and its fluctuations over the next 12 months. Based on the 4 economic factors discussed in this market view, we have decided that the Australian dollar will appreciate against the US dollar over the next 3 to 6 months. This is based on higher inflation in America and rising commodity prices, which increase demand for the Australian dollar. Thank you for watching our presentation, and we hope you have a great day.